All right. Well, let's just jump into it, and then I got this recorded so I can send out to everybody when we're done. So first, thanks everybody for joining the call. Thanks for doing this investing thing with me. It's a lot of fun. Learn a lot every day, and I'm excited about today. So if you've been on this before, you know we're going to talk about finance lending. So Patrick Stoy owns MC Capital and MC Mortgage and a lot of investments. And he's going to walk us through what's going on in the mortgage finance world. And then Sean McDonnell is going to talk to us about what's going on nationally and locally from a sales perspective. I'll obviously talk about some rental trends, both nationally and locally. We got some exciting things happening here in especially Sneads Ferry. And then I'm really pumped for Ryan Casey, and I'll give him a much more formal introduction right before he starts talking, but a phenomenal human being, a Marine Corps pilot, and exceptional entrepreneur and financial planner. So, and then lastly, we'll finish out with some Q&A. So without further ado, Patrick, what is going on in the mortgage world right now?
Rates are moving around. They're definitely, from one day to the next, we're seeing a lot of volatility, essentially. What the forecast that we're expected to see in rates is kind of what this graph is. It kind of shows out here is what the recession that was expected for 2023 never really materialized, essentially. Student loans got kicked. Jobs are being created. So right now, the forecast is that once we get into first quarter and second quarter of 2024 is where we're going to start seeing really negative GDP. And then from that standpoint is when we'll start running into a recession, which again, recessions are normal cycles. You've got your up times, you've got your down times, so you have to average out. So it's not a bad thing that's coming. It just kind of comes in and fixes things and normalizes the market. Needless to say, going from rates down and, say 2.75 to now that we're seeing 8% essentially for a primary residence, we've seen the biggest increase in rates that pretty much that we've ever seen since the 80s.
Yeah.
Just since I've been in the business and really studying this back to the S&L area.
So we're looking at like a 9% interest rate right now for somebody that's buying an investment and going to put 20 to 25% down.
Well, here's really what's happening. So the rates are still going to be in the 8s, but the issue is the life expectancy of a mortgage is 5 to 7 years. So what happens is when they price these out, because the biggest thing that we're seeing right now is people have to pay points up front, which nobody likes spending money to borrow money. It always kind of stinks. But the average lifespan of a mortgage is 5 to 7 years in a normal market. So what's happening is because the banks know that they're basically going to get paid off in the next 1 to 2 years, they're collecting that money on the front side as an upfront expense instead of making it every 30 days based off of your interest.
Okay.
So it's more expensive to borrow money right now because you actually have to pay for it on the front side instead of spreading it out over the amortization.
Does that mean, and anybody, if you have questions for Patrick, just stop and ask a question. Patrick, to me that means, or does that mean that lending is more competitive now?
Lending is more expensive now on the front side.
So does that mean I can shop lenders around more? Not that I ever shop lenders, I just call you. But no, if somebody did, is this like a shopping environment?
Well, I mean, you always want to get a second opinion. I mean, that's just good, just being a good consumer. But what I'm getting at is that the cost to, just take an example for 8%, even on a primary residence right now, you're not going to get that at what we call par, to where it used to be like, hey, we're going to give you this rate with 0 points. You're not going to pay a discount point. There's no origination points, literally at 8%. To where if you wanted to pay 1 point, you maybe could get down to like 7.25, 7.5, somewhere in that range. Right now, there are no par rates. Every single rate is going to have some kind of discount associated with it because the investor knows that mortgage is only going to last for 12 to 24 months, period. Not the normal 5 to 7 years. So they want to collect that premium on the front side of it.
Okay.
So it's just more expensive in that market. Now, what I will tell you is a good place to check around are credit unions. Credit unions, now they're not going to give you a 30-year fix. I mean, most of our products are going to be 30-year fix, Fannie, Freddie, even our capital markets are going to be, 30-year fixed products. credit unions are using their own money, so they are not at the mercy of having to sell it on the secondary market, basically. So if you are going to shop around, I will tell you right now that credit unions are offering better deals, I guess, good way of putting it. And I'm in the mortgage industry, but I will tell you that check around with the credit unions and see what you can do, because they're going to give you generally an arm that's fixed for a certain period of time. So if you hear what like a 5-year arm, a 7-year arm, a 10-year arm is, what that first number means is that 5-year arms means that rate is fixed for that time period. So 5-year arm is fixed for 5 years, a 7-year arm is fixed for 7 years, and a 10-year arm is fixed for 10 years. So it gives you that initial period that it's fixed. You don't have to worry about it. Now, the idea of doing that is that you're going to go get that ARM product right now. And as soon as fixed rates do start stabilizing and come back, you want to roll that over essentially with the refinance to a fixed product, because you don't want to ever have to worry about requalifying or being at the mercy of what the market rates are when that ARM comes due.
Right.
You adjust for the first time.
Okay. Is there an option to get a par rate and not buy the rate down? If I'm looking to buy something, I'm going to hold it for 15, 20 years, and I want a cash flow, and I'm going to put a sizable down payment down, that's going to really lower my rate. So I might not care about a 9% interest rate.
Yeah. So the way it works from a pricing, they're called what are called LLPAs in our world. From 0 to 60 is the best pricing. So if you're going to put 40% down, you might be able to find a par rate or it'll be the cheapest discount that there basically is, but you got to put that 40% down up front to be able to do that. So if you're doing a 1031 coming into something, you might have that. Or if you're just wanting to tie up a lot of cash because it's either a forever property, a legacy property that you're wanting to do, there's that option. What we're seeing and to go from a par rate to a pay, so let's just say paying 1 point, literally can be a full point in interest rate. So it's a matter of doing the math on it. And that's where every situation's different based off credit score, loan to value, loan amount, everything. So that's where we really sit down and figure out, what is the best option? Does it make more sense for you to actually put 5% more down in equity because you're going to pay 3 points here at this loan to value, to where if you take that 3 points and instead of paying it in fees, you actually put it as down payment. Granted, you're going to put 2% more in. It brings your cost to borrow the money down, because in the day we all want equity position. We don't want to waste money on
right.
fees.
And then in 2 3 years, we got to refinance anyway, and that's more expense going into things, which is why I asked that question.
Correct. So that's why just every situation is different. That's why I like to have a true mortgage consultation with somebody to understand what they're trying to accomplish. Is this a cash flow property or is this a legacy property? Now let's kind of figure out which one makes the most sense, because as investors, that's it. It's either cash flow or legacy.
Mm-hmm. Sweet. Well, yeah. Thank you for sharing that.
One more thing, Skylar, just throw it out there too, since we're talking financing. Don't be afraid to request seller financing. We just got a great deal under contract yesterday at 4% with seller financing. So,
how did you begin that negotiation, bro?
What's that?
How did you approach that with the seller?
I had a feeling, just based on the property, how long it had been owned and everything, that they would be open to it, even though it wasn't listed as seller financing. So I asked Andrew Davis, who a lot of you guys know, works with Sean, my agent, to ask them about seller financing. They said they were open to it. They came back with the number they needed for the down payment. And after that, it was just a couple back and forths. But we made it clear that because we were planning on holding the property for a very long time, that the ultimate purchase price was less important than the term and rate. And so we got the term and rate and AM we wanted, and they got the purchase price that was close to what they wanted. We still got it below list price. But so yeah, check when you're looking at a rental property, check the history of the property. Was it sold 15 years ago? They may not have much of mortgage left. Or they'll have a lot less after all the appreciation. So they may be open to seller financing.
Mm-hmm. Great. Yeah. Thanks for sharing it. Because seller financing is this thing, right, that's shared about on podcasts and the chat groups, but having somebody that's doing it right now and how to broach that subject. It's helpful. Thanks. Patrick, you want to really quickly talk about your different
Yeah, absolutely.
products out there?
So pretty simple fix and flip loans. You can either do fix and flip, or you can do basically buy and value add. We do put money behind you to do those. Off the market will go up to 75% of whatever the future value of that is. So if you're buying it right and rehabbing it right, you could essentially get 100% financing to do your project in and out, or in and then turn into a rental. Bridge loans, just taking equity from one property and using that for a down payment for the other. Doing some ground up construction, because right now inventory is tight. It's a great time to basically go build the property instead of trying to find one and rehab it. If you've got access to land, or somebody's trying to get rid of maybe a manufactured housing on a lot, get rid of the manufactured homing, and then get rid of the manufactured home, and then go in there and build a home. Long-term loans, we've got debt service ratio, where we use the cash flow of the property. We close it inside of an LLC. We don't get into your personal financials. It's really about the cash flow of the property. And then we've got Airbnb loans, where we truly use Air DNA to qualify the property, either that or the historical on the property, which is nice. And then we've got the no ratio loans, to where we actually don't look at any income, but you've got to be able to put 30 to 35% down on it, have good reserves, those kind of things. And then the multifamily, which has really just gotten interesting, guys, and people, y'all as investors. So Fannie and Freddie just changed this, that a person buying a primary residence can now buy a duplex, triplex, or a quad with only 5% down. So that is huge for primary residence people buying. But for investors, if you've got some of those in your portfolio, with this coming online, it's only going to drive up that demand for those properties, because who doesn't want to go in there and buy basically a quad and be able to house hack it, live there rent free for only a year, and then they can go buy another property. Okay, so a very good opportunity there, where you want to build them, go to the ground up construction, or if you're sitting on them, there's just a wave that's getting ready to happen, the demand for those, because a lot of people, it gives them rent free if they're able to come in and do it, and they only have to put 5% down and live there for 1 year. That's a big thing coming to the market.
Yeah, for sure. Cool. Thanks for sharing, Pat.
Yep.
Does anybody have any questions for Pat before we move on to talk about what's going on in the sales world? All right, so I think most know Sean McDonald on here. He's a great friend of mine. He's a phenomenal human being, and he runs the best real estate team that I know, and by far the best real estate investor focused team. He's an investor himself. He's helped a lot of people buy a lot of properties and make a lot of money. So Sean, over to you.
Thank you for that very nice intro, Skylar. Yeah, hey everyone, good to see you all. I'll talk just a little bit about the national stats and then really focus more on what's happening locally, because it's not the same thing. But you can see nationally, transactions are down a little bit this year from last year. Median price is up, a decent amount for, if you watch the news, you might not believe, that prices are still going up. But they are nationally, even more so locally, which I'll get into. And then there's a couple of quotes from this guy that I follow. He's like the chief economist at the National Association of Realtors. Lawrence Young is his name, and they put out a lot of helpful info every quarter, in my opinion. But basically, home sales have been stable the last few months. Mortgage rates have had a negative impact short term, but job gains in the economy have a positive impact long term. And then, I thought it was important to note to you all who are invested locally in the South has a lighter decline in sales, just due to a lot of southern states are seeing massive population growth still, really started since the pandemic. Locally, though, I'm not going to read each stat for you, but you can take a few seconds to just read through these stats. But across the 3 counties that we really operate the most in, average sales prices have gone up pretty significantly this year compared to last year, even with the interest rates doubling in most cases. Onslow County, almost 10% increase, Pender County, 3.5%, New Hanover County, 8.5% increase in property values. And we believe that a lot of that is due to a fairly low supply. So you can see I included inventory numbers where new listings that are hitting the market are down significantly across the board. So we think that the lack of supply is helping keep values steady because there's still a lot of demand for people buying. I used to think and believe that it always made more sense for people to buy rather than rent, but that is not necessarily the case anymore. I think kind of what Patrick was saying, it's even more important now to have, a good consultation with some industry professionals before you make a decision to buy. I'm talking more on like primary residences, but where it used to be even cheaper to buy than rent here, that's not always the case anymore. So I would say it's even more important to build a good team, and each situation is different. But yeah, that's really what's happening locally here. We're really digging into this fourth quarter of this year, trying to provide real-time updates for what's happening in our markets. And we're looking into like price to rent ratios and what is the ideal size property to buy as a long-term rental. And if you want to be added to our email list, I know most of you are already, but just shoot me a message and I'll add you to our distro list. We want people to be, as informed as possible in order to drive your decision-making on the investing side and for primary residences as well. And then just one last plug, we have a real estate investing meetup tonight at the Cove at 6 p.m. in Surf City. So please come to hear some fun stories about some of our lessons learned in real estate investing.
Sean, what are you dressing up as?
I have been asked to dress up as a lumberjack, but I have not agreed to that yet, so I'm not committed.
Okay.
But yeah, if anyone has any questions.
Two of you that has the beard for a lumberjack, so I'm not sure it should be Sean.
That's true. That's a good point.
I'll wear my flannel if it gets me a free drink. Yeah, lots of good stuff. Price to rent ratios are actually changing in this market right now. And I think it's really interesting, Sean. You're looking at the supply, right? So prices are going up, but all the listings are down from last year, which is we're really feeling in Eastern North Carolina. So on a national front, rents have really kind of flattened out. You can see that they dipped there late last year and in the spring. Because there's so much building supply that has finally hit the market everywhere. So there's a lot more supply for people to live in than there has been on a national scale. And then on a local scale, I've never seen more inventory here in the last 11, 12 years. So there's a ton of building projects that have been completed, from apartments to townhomes to single family home tract neighborhoods. If you just go look right now, there's 36 3-bedroom, 2-bath homes for rent in Sneads Ferry, which is like the smallest micro market in the area. That's just a ton of inventory right now. You have a lot of people, Marines or servicemen here, that have low interest rates because they bought a house in the last 5 years or 10 years, and then they are now moving away. So you have a lot more landlords. They're like, hey, I want to make money. I got a 2.5 interest rate. I can rent it out for $2,000. It just makes sense. So you have so much supply right now. Just it's cool to see. And also just want to make people aware as they're buying things, know that it's taking longer to list stuff or to lease it up. We're seeing, this is an MLS stat, only 25% of properties are being rented in the first 30 days. From 30 to 60 days, you got about a third of the supply getting leased. And then from 60 to 90, you have about a third of the supply. And then there's a portion of stuff that's taken more than 90 days to lease. We're doing better than that at Cedar Ridge. We're seeing about, depending on the type of product, between like a week and probably 35 days. I'm super open with everything, but last year you could do less work to a rental property to get it ready, because there was so much less supply. Now you have to make sure things are a lot nicer, and you just have to have the expectation that turns are going to be more expensive, because we want to make sure things are painted and fresh and crisp, because you're competing with so many other properties out there right now. And that's like an experiential thing that we've gone through because there's more supply. And that's the same in Jacksonville, Swansboro, Sneads Ferry to Hampstead, Wilmington, and Leland. But is concentrated, I'd say that biggest change is felt in like Sneads Ferry, Holly Ridge. But really all over the place, we're seeing rents not go up. You can see this is what you should expect for that type of product in those areas. In Jacksonville, 2-bed, 1-bath rents went down actually a little bit. Same with 3-2s in Jacksonville. And then if you guys look at the 4-2 space, particularly in like Sneads Ferry, Hampstead, Holly Ridge, and Wilmington, based on the type of product that you have, like is it granite countertops, is it stainless steel, is it really, really nice, or is it just big? There's a huge variance in what you can get the thing rented for right now. So if you are buying something, before you're under contract, really do reach out to me and ask what the price is, so we can set you up for that expectation. And does anybody have any questions about rental rates, leasing times, anything that's going on nationally, locally? No? Cool. Well, now I'm going to kick it over to Ryan Casey. Like I was saying earlier, phenomenal human being. He got out of the Marine Corps, 3 years ago?
6.
6 years ago. But you were in the reserve for a while, right? And
That's right.
Yeah. Okay. So 6 years ago, he got out and joined up with Tilia Partners, and has just done a phenomenal job. I think I don't know if I read this on your website or somewhere, but you got over 160 million now under management.
Mm-hmm.
And are just doing a phenomenal job, guys. I met with Ryan when I got out of the Marine Corps. I brought him my financial plan and was like, hey, this is what I want to do with my life. I know where I want to go, but I don't know how to get there. This is what I think the map looks like. Can you point me in the right direction? And he's been a wealth of knowledge, and is just excited to help people out. And I'm excited to hear what he has to say about today. So Ryan, over to you.
Well, thank you, Skylar. It's really nice to be with all of you. I'm one of the co-owners of this company, but I want to talk about, I am also a fellow real estate investor too. I'm a big believer in real estate. I have bought and sold rentals myself. I own this commercial property right downtown. Huge fan of it. And because people tend to think of almost as diametrically opposed. Either I'm all in on real estate, I don't trust the stock market, or it's like, hey, I've got my stocks and bonds. I know that I'm not going to get in the rental game. I see and appreciate what both of them can do, particularly in concert together. And so, Skylar reached out to ask me to share some insight. I'm going to try to boil down my thoughts to make it as absolutely relevant and big picture as possible. But big picture, I kind of wanted to I saw something in the news this morning, and it was Bank of America. They had some analysts, and there's 2 interesting facts that just came out that I think will put everything we've just discussed into a broader context. The first is that bonds, and so mortgage debt falls in that same category. There's IOUs, but everything from treasuries, corporate debt, mortgage-backed securities, all of it. The period that we're going through right now, rapidly rising rates, to be a bondholder, it's been the worst time since America's been founded. Like, it's absolutely, this is the worst time. Again, it's like, you as real estate investors and owners, you're actually benefiting because you own property with equity, and yet the cost of that capital is incredibly low. And the people that actually issued all that debt, they're the ones that are sitting on gigantic losses. That's what caused all the Silicon Valley bank run stuff earlier in the year. All right, cool, whatever. The other piece, more interesting to me, was that not in recorded history, so in the past 5,000 years, the cost of capital has never been as cheap as it just was up until 2 years ago. And so that reminds me of, like, when I read those things, and I already had made this slide, big picture, the thesis that, at least because we're an independent investment management firm, and so we're paid by folks to manage money and say, like, hey, we want to put this and grow it as efficiently as possible. Nobody likes losses, everybody wants gains. Well, the thesis that we have, and everything I see in the news, whether it's Ukraine or Israel or Chinese warships circling Taiwan, they're all pointing to the same big picture, which is, in the last 4 generations, we just think that every year your GDP will grow and that borrowing is incredibly cheap. And so but that actually is not, and the world's relatively peaceful. That's actually not what most of human recorded history has been. It's mostly small regional conflict of neighbors fighting over resources. And there's various economic systems, mercantilism, colonialism that have come out of it. And only since the end of World War II did the US say, hey, in exchange for everybody ganging up against the Soviets, we'll encourage free trade and allow freedom of navigation. And thus everybody can get rich. As you gang up against the Soviets, we'll all get super rich. And that's what the world's been doing.
So, Ryan, to ask a question about that for clarification, because I'm not as smart as you are. Post World War II, we come off the gold standard eventually. We start printing a lot of money, and GDP has gone up because of inflation, right? We print more money, and that helps drive production, but not necessarily. And we're going into this space where we now have to focus on being productive to increase our GDP.
Yeah, absolutely. Like, I would argue that you could say it's inflation, but then objectively you can look and say, for not less than a week's wages, right, or a fraction of a month's wages, you can have a smartphone, right, that can connect to the entire plane, call an airstrike on this thing, or the fact that our lifespans have increased. You could I think objectively say our standard of living, our wealth has increased exponentially since the end of World War II. Again, what does this matter to you guys? Is this being in a real estate investor call? What I think is happening is that we're just going back to the normal, which is very high cost of capital. That's the thing that I don't think is fully reflected, or we're all kind of just hoping that, all right, in a little bit, interest rates will fall. And I do think they will fall. I tell my clients who are buying houses right now, I'm like, hey, hang on. You want 12 to 24 months, you should be able to refinance, but you are not going to see in your lifetime 3% interest rates. That is not coming back. And there's more reasons behind that I'm going to bore you all with, but I'm firmly convinced that the driver of growth, which is a combination of demographics, free trade, those things are gone and they are just not coming back. I am very optimistic about the United States, not for nationalistic reasons, but because we're net energy and food exporters, which is a benefit that few other countries in the world have. And we have good, stable trading relationships with our major partners. And we have a military that's able to enforce our interests worldwide while no longer being committed to defending anybody else's. I'm not saying that's good or bad. I'm just saying that is like the direction of the country. So from an investment thesis, what I do is, like, I take all our client money, hangs out in domestic manufacturing, everything that's related to improving productivity, because everybody's going to have to do a lot more with less. So agriculture, manufacturing, utilities, a small degree of railroads. That's everything we own is more or less, it's big, it's defensive, it's domestically based. And I think that I'm not worried about hyperinflation or the dollar being replaced. Even though there's good argument as to why we're putting ourselves in peril, there is no other reasonable, even remotely reasonable alternative to the current system. So my thought is, as the world becomes more disordered, you want to own stuff that you don't have to worry about. You're changing your supply chain. You don't have to worry that if the Chinese collapse or we do trade war because of a hot war in the Pacific, you don't want to be left holding the bag with with at least your investment portfolio. So same thing with bonds. It's just we have a shortage of capital and labor, and those things they're just not going away anytime soon. The real estate piece, like again, I think it's a fantastic investment. And it's because it's the same principle in investing. It's whether a small business owner or your portfolio's in, it's just in a handful of stocks. We have a saying in the community. It's basically concentration builds wealth, but eventually diversification is what keeps it. So some of my wealthiest clients I manage a small chunk of their overall wealth, and that overall wealth is spread out in real estate. But what I tell them every time I have a review is like, this has made you very wealthy, as it should, because with concentrated risk, concentrated real estate, there's concentrated reward. And the beauty of real estate is it's hyper local. You have the ability to add sweat equity. If you're savvy about how you finance it, manage it, you're in good hands, again, with a good team. But it also is, the reason there's that premium is because it is concentrated for risk. And so for folks that own real estate, I say, look, if anything, like you've made your fortune, consider, if you're going to own real estate and have that be a substantial part of your overall net worth, like do not own it all in one hyper localized area like coastal North Carolina. Like consider buying stuff out, wherever, out in the mountains of North Carolina or somewhere else, a different geographic area, the different economy, different demand cycle. You're just going to protect your gains. So unsolicited, I included a quote from the Wall Street Journal that was from just last week. I will tell you that and anecdotally, I'm sure you all can see it. The price of housing at the current interest rates, I do not think is sustainable. And that's just not my opinion. There are real estate investment trusts, things that trade like a stock. You can buy and sell it, like, right now on Schwab or Fidelity. Those things are trading at 20% discount off of the book value, which is the investment community saying your portfolio may be worth $3.7 million on paper, but we don't actually think, based on the cash flows, based on the rental income that this thing can generate, it's worth a lot less than that. So when I tell my clients, I'm like, look, you're buying a primary home, you're good. If you're buying a rental, you have to make very sure that your cash flow is going to cover that debt servicing and that you can't count on a quick refinance in 6 months or a year to provide you pressure, because that may not happen, especially if rental rates decline. So again, it's my job to just be the like, hey, these are some possible scenarios. Here's some downside outcomes. Here's some upside to it as well. So that piece aside, I wanted to touch on the Treasury yield curve, and I'm sure, and I know Patrick already touched on it before, but the yield curve, in essence, if you guys can imagine like stairs just going up. So from my perspective, right, stairs start here, right, they go up here. And effectively, if you are lending money to an institution, because that's what you do when you buy, when you're lending, you expect, if it's for 3 months, I'm going to be paid a certain amount of interest. But if I lend you money for 30 years, I better be paid more interest, right? Because I have a lot of risk. Inflation could get out of hand. You may default and never pay me. So in a typical yield curve, and we use like US Treasuries to note this, it should just be steadily going up in a normal economic environment. But you've probably read that the yield curve is inverted. And so all that means is it's the bond market, which is bigger than the sum of the entire stock market on the planet. Bond market's even bigger than that. So there's a lot of money in it. Actually, may I see if I can cycle? Skylar, can I move to the next slide?
Sure.
How do there we go. Yeah, it's a screenshot from it.
Oh, sorry.
That's all right. In a nutshell, the yield curve is deeply inverted. And what does that say? So there's two things that come out of it, and you guys can't see it on screen. It doesn't matter. What it's showing is between 6 and 9 months, the bond market thinks that interest rates, which deeply impact what everybody here is doing, that interest rates should decline. So it's a thought that we're going to reach the breaking point in the economy, and the Federal Reserve will cut interest rates. When treasuries fall, particularly 10-year treasury, that is typically what mortgage rates are tied to, all right? Because it's the treasury is a risk-free premium. Mortgages are just some sort of percentage on top of that. So the good news is if you were a client saying, I'm going to buy a rental, I'd say, great. I can tell you the bond market thinks you've got a small decrease in interest rates coming in the spring of next year. Cool. If you look further out on that yield curve, you find that it continues to decline all the way out to the 10-year mark, and then begins to tick back.
So Ryan, inverted yield curve means that just looking at this picture, my 30-year rates are lower than my 3-month rates.
Correct. That as an investor, you should be demanding a lot more from a 30-year, but people are. It's just a difference, and there isn't enough demand right now. So people are willing to, or basically the Treasury has to offer really high interest rates to get people to give them money.
Okay.
Yeah. Long term, this is, I hope this doesn't persist, because if interest rates remain high, that will suck all the capital, all the money that you have. It'll pull it out of the economy. It goes out of small businesses. It goes out of people investing. Because everybody will just end up buying treasuries. Because if you get a 10% guaranteed return, you're like, why am I risking it doing anything else but that? So I for all of our sake, because what I do is tied to these very much. I do not hope these stay high, but just as I just said in the other slide, I am convinced that they will remain elevated and remain there a lot longer than I think people expect or realize. The last thing I had on the other side, we have to go back to it. So as a financial planner, I kind of want to point out just a few things. There's a lot of information out there. Like part of how I make a living is being like, all right, I know a lot. I have a very broad knowledge base. And so that you can take something and say like, okay, this is credible information and can be applied as a strategy, and this is garbage. I will tell you, not because I have social media, but because I've had clients pull it up in here. You get any sort of real estate strategy from somebody online, like I promise you, it's almost all garbage. It's almost all crap. Complexity is the enemy of for you as an owner and an investor, complexity is your enemy. You should not be confused by how your properties work, by the ownership structure that you have, the risk management that you have in place. None of it should be complex. There is no need to have offshore accounts or to place everything inside of a trust. Like there are.
Yeah, Ryan, I think you're starting to talk about how do I hold my real estate as an investor. Just want to kind of clarify that.
Excuse me. Yeah, I'm just attacking all the stuff I've seen. I'm like, hey, look, it's your money. You go put it into the stuff.
So Ryan, I have, just hypothetically, I'm buying my first rental property. Should I put it in an LLC, or should I start my first revocable trust?
It's always situation. I would not put it in your trust. There's no benefit to putting it inside of a trust. I'll define it real quick. So trusts are just a vehicle. You create them and you can fund them. Most of them are revocable. They're tied to you. There's no tax benefit to them. They're really good for avoiding probate and controlling assets after death. That's it. There are specialized charitable trusts. that typically are when you're trying to avoid gift tax. So if you think you're going to have north of $28 million estate, yes, there is actually detailed trust planning that like a financial planner can walk you through and say, okay, this is how I can shield or hide assets, push them out of your account. There's also specialized Medicaid planning involving trusts. Again, putting them into a vessel, permanently relinquishing control over it, and that lowers your balance sheet. For our purposes of our discussion, none of that applies. You don't need any of that stuff. Why do we even have what's the purpose of having a vehicle? It's to protect yourself against a lawsuit liability. So when I had rentals, I just kept, all I did was I went out and got an umbrella policy. So you can talk to your insurance agent, you'll increase all the liability because you're worried that your tenant slips and falls, and then their insurance company or their medical company then comes after you. They look up and they go, oh, okay, it's owned by
Skylar Witt.
Yeah, exactly. Skylar Witt owns this. Okay, sweet. We're gonna sue him now for damages, right? Well, when you have a liability policy and it may be $1 million or $2 million on top of the underlying coverages, like what you're really paying for is then now your insurance company will lawyer up on your behalf and defend you very aggressively. The insurance company doesn't want to lose that money, and typically it's a few $100s more per year. Depends on how much we're insuring. So, but to me, that is how like most small investors should protect themselves. Many of you likely have LLCs. I love LLCs. They're fantastic. This building is contained inside an LLC. It's $125 to file articles of organization here in the state of North Carolina, and about $200 per year to renew that. So very low cost to carry it. An LLC will accomplish many of the same things of umbrella in that you still have to insure that property, but a catastrophic lawsuit that's basically has to do with, let's say, your multifamily should not be able to puncture through and touch you personally, your personal assets, your house, your retirement accounts, all those things, your other properties, right? The issue with them that I see is that people will create these LLCs, and then I'll say that's fantastic. When did you have your last meeting? And they're like, what? And I'm like, do you have notes from your your board? You're all the members there that are part of it, whether it's a solo or husband, wife, or you have other business partners. Well, do you have at least an annual meeting where you have minutes? And people are like, no. All right. Do you have any documentation that proves this thing exists? No, I don't have any of it. I mean, I file my stuff at the state. Well, then that LLC really isn't doing a whole lot of good, because then you probably heard the concept of piercing the veil, where an attorney will just go, yeah, that thing's just a shell. It's still Skylar Witt. He may call it Cedar Ridge Management, but that's totally just Skylar, because there's nothing that really shows that it's separate. So, keep a separate checking account that's titled in the LLC.
And then if that corporate veil is pierced, there's no legal protection.
Yeah, then it's all over. It's like, okay, cool. You might as well have just had the liability, the umbrella on top. So for a professional real estate investor, absolutely have it, but put the time in to follow through. And that's where I would talk to an attorney if I were you about that. Hey, what should I be doing here to just make sure this thing is airtight? Because I can't afford a wipeout, right? Nobody wants to have that. They're very low probability events, so most of the time these things, they just don't happen. But again, a lot of my job is just to worry about the low probability but high outcome or high impact events that can occur. But I wouldn't put them in a trust. Umbrella and then an LLC are totally fine.
And fine, but also sequenced properly, right? So I should probably have umbrella insurance right now if I have a rental. If I'm hyper conservative and protective, and I'm the guy that uses 4x6s for my kid's tree fort, right? Yeah, have umbrella insurance. But I don't necessarily need an LLC if I'm also going to have umbrella insurance. And again, guys, I'm not a lawyer. Ryan's not a lawyer. So just know that wholeheartedly. But the easy money to sue for is going to be insurance payout, and the headaches associated with maintaining the corporate veil on a bunch of individual entities is probably not worth somebody's time.
That's right. Again, very low probability event, but all the other things I've seen, Here's the thing, trusts are pass-through entities, S corps, LLCs, they're all pass-through, as in like there isn't a you're not receiving a some sort of special tax break. You do if you file as an S corp, and you're an LLC and you file as an S corp. So if you do this professionally, absolutely get a good CPA, and sure you should be able to get a 20% QBI deduction. You can write off your health insurance and mileage and all that other great stuff. A CPA is worth their weight in gold when it comes to that. And they also are going to be the ones to advise you on the most efficient structure. So I always tell clients, well, look, I'm a planner. I know about all these things. You got to actually ask the CPA what he or she thinks is the best option there. But I can tell you holistically, that's what you're aiming for. Simplicity, straightforward, insurance, then LLC. And at that point, build a strong team around you. You should talk to a business attorney. You should talk to a CPA.
I should bring on a CPA next quarter.
Yeah, they're all drowning in work.
The good ones are anyway.
They are. But yeah, they're perfect for that kind of the tax end of it. But just anything else you see, I'd be happy if anybody has something they've seen on social media, like fire away. Be like, well, Brian, I heard if I like had it, like I'd be curious if somebody has something, just
Ryan,
so I can.
I should get an LLC for every property, and I should label it 123 Easy Street, and just have a name that's completely not associated with me, so nobody can find me. That's what I should do, right?
Right. Yeah. Because you can do a quick search and tie ownership, right? And then you put it all inside of a trust or something. Like again, whenever you deal with a professional, like you should never be confused. It should not be like, I don't know what the heck this person's saying, but they must be right. Like if they're a professional, it should be very understandable. There shouldn't be anything that's crazy about what they're saying. I'm telling you, complexity is the enemy of any good plan.
All right, so I'll flip the question around. When is a good time, from your professional opinion, with full understanding that you're not a lawyer or a CPA, when is the right time to get an LLC for a single family home portfolio? Like how many properties would you recommend?
Oh, I mean, hey, if you're doing it, like there's no reason not to start at one. Like you don't have to. I don't know. I couldn't tell you when the perfect number is. It's also related to it's like basically how much are your assets outside? What's your balance sheet like? Do you have a ton of home equity and a big fat stock portfolio and a business with like that's worth something? Well, hell yeah, you probably want that LLC right away, because I'm not going to let anything threaten this. Or it's like, no, everything I own is in these rentals, so there isn't a whole lot of money with me. And so, okay, well, still probably want to put inside an LLC, but there's less of a case, again, because it's all just trying to keep your personal stuff from getting wiped out in a lawsuit.
Mm-hmm. Okay.
I have a question for you, Ryan. I concur with a lot of your kind of grand, like your big picture view of the U.S. and the future of rates and all that. One place where I diverge a little bit is I think that the possibility of very high into the realm of hyperinflation for a long time is pretty real. Curious as to why you don't see hyperinflation as being, particularly if the Fed is forced to drastically cut interest rates, and with the geopolitical movement away from the dollar by a lot of BRICS nations. Why all that, 40% of all US dollars were printed in the last 3 years. So that hyperinflation is a big concern with me. And I'm just curious as to why you don't see it playing out that way. If you give me a synopsis.
Well, I'll give you a few things. The bond market is over $140 trillion. And I can tell you, and that shows up in the US Treasuries. And the market thinks if you look at 10, 20, and 30-year rates, you don't see the market anticipating hyperinflation. Otherwise, you would see incredibly high rates there. What is it? 4.75 and 4.9 going out. So one, that's so when I look at that, I go, okay, at least the market, it is much higher than it used to be, but the market is not telling me we think hyperinflation is coming. At any one of those checkpoints, I don't see it happening. The other thing about the the Egyptians and the Argentinians and a handful of other countries are like, we're going to do trade in limited commodities outside of the dollar. I do not think that the European Union is going to exist in its current state for much longer. I don't think the Chinese are going to exist as a state within the decade. I don't really think there's a meaningful alternative economic model or source of capital and people production elsewhere on the planet that really is going to provide a feasible alternative, because you don't just need scale, you need liquidity, you need the ability to instantly transact. There isn't anything even remotely close to that, and I don't see those things as rising threats to the US dollar. I actually see them all in decline. And so it's not that the US doesn't, we do. The only thing that makes me pessimistic is if we, from a like economically, I'm very optimistic, very bullish. And most of my wealth is tied to the US domestic stock market, large cap stuff, and in the industries I mentioned, as well as real estate, and then a business, small business. I'm not worried at all about any of those things, except severe political dysfunction, the inability to pay debts, or the threat that we might not pay our debts. That's the one thing that would spike. That would, all bets are off in that scenario. I think it's a low probability event, but I don't. The most likely outcome in my mind is that you watch a lot of disorder occur overseas. It's you see a breakdown in trade, the cost of everything. Agriculture is going to go through the roof. I mean, these other countries exist because of a globalized world that allows them to make one little widget very efficiently and sell it to somebody else halfway across the planet. But when you don't have, the ability, you're fighting with your neighbor, you don't have the ability to safely ship it, or somebody's going to impose their tariffs on it, things that we just aren't used to since World War II, well, then your widget isn't very valuable anymore. And a lot of what your country is built around, it becomes much more the foundational stuff, like, can we import enough of our food? Because we sure as heck can't grow it. And I'm thinking of like the Middle East, right? Like when I'm saying all this stuff, they may be wealthy, but there isn't the natural. You either need energy and agriculture, and preferably both, in order to thrive, or you need partners nearby that are willing and able to trade with you. I don't see anything else like that around the world. I think there'll be countries that do okay, but I'm not worried about hyperinflation.
I appreciate the answer.
Does anybody have any other questions? We got about 5 minutes left. I got a ton of questions, but I don't want to monopolize the conversation.
I appreciate all of you letting me hop on and share a few nuggets here. I think what you're doing is awesome, and real estate's just a great asset class, and and you're doing the right thing. The fact you guys are here now talking to experts, I'm like, you're doomed to be successful, as I like to say.
Yeah. Sweet, Ryan. Well, thank you very much. And the takeaway, like always, guys, be smart, know what you're doing, make wise decisions. And what's up, Patrick?
Hey, one thing I want to point out why you've got this chart up here, and thank you for having this. So the interesting part of where the risk spread is right now, if you look at the 10-year Treasury, our normal spread for mortgage-backed securities is about 1.5% higher than that. So if you look at that 10-year where the 10-year Treasuries trade, which right now 4.733 when you did this, you would normally just add 1.5 to that, and that's normally what you're seeing mortgage-backed securities. So you can see the massive, I mean, it's double that right now. So just a way to understand what mortgage-backed securities are usually doing in a normal market is 1.5% on top of the U.S. Treasury.
In a normal market.
In a normal market, but you can see it's double.
Ending a lot more.
Mm-hmm.
Yep, but it's double that amount right now.
And that's just government involvement in trying to stabilize something that's kind of gone crazy.
Well, Ryan, what you said that's more supply and demand. I mean, it's really just other people.
It is. Yeah, the government can't set. So these rates it's still set on the open market. So that's just people are like, I'm not buying your crappy treasury unless you're paying me at least. It's actually like 4.6 as of this morning. So, basically the same thing. But it is, the Federal Reserve can influence it. They're, buying up that and whatnot. But this is, the government really is at the mercy of these rates. And that's, separate bank. But I saw somebody else raise their hand. Thought.
Michael Freelander. What's up, Michael? Can you hear us?
His microphone's off.
Okay, sorry about that. Questions for Ryan, and I appreciate all the presentations. Really good information. So, are you saying that having an umbrella and then having an LLC, is that duplicative? Is not needed, or if you want an extra level of protection, is that good?
Yeah, to some degree they are. They're doing the same thing. They're shielding your personal assets. Umbrella is, to me, the first thing you do, and then you can always layer on the LLC if your personal assets are significant. Because an insurance company is not going to sue you if they're like, there's nothing for us to recover from this person. They're just going to be like, all right. But yeah, the more complexity, the larger the scale, the bigger your investments, the more that is, like, the more like, yes, an LLC is going to make absolutely total sense. If you have one tiny rental and, I think umbrella will be totally fine. But if you're willing to pay the fee and go with a little bit of paperwork every year, then great, toss in an LLC, give it a cool name, and you can put more as your portfolio grows. You can keep tossing them in there.
And would it be hard to change it later if you need to go to something like, say, an S corp?
No, when you are an LLC, you can actually elect to file as an S corp. So your accountant will do it. There's some pretty sweet tax rules now. I mean, just this year, you can write off all your state income tax through your pass-through entity. But you have to be an operational S corp to do it. But again, get a good CPA. I know plenty of CPAs, but they're not your $800 a year. They do like detailed tax planning. They're kind of folks that I like to work with them because they do just like I take like tax returns and I like rip them apart and we do pro forma. The accountant will do their heavy duty stuff and we work in concert together. Get a good CPA and make sure they actually have CPA after their name and it's not just like Joe Blow. Because a lot of people, they call their accountant a CPA and that person is a tax preparer, not hating on them, but they are not qualified to do like heavy duty, like in-depth analysis, nor are they typically up to date on what's happening with the tax code, which is about every 6 months. That darn thing changes.
Well, yeah. Well,
Thank you.
Ryan, thank you so much. Guys, you can look him up at tiliapartners.com. I know he'd love to sit down and talk with you and figure out where you're going and help you get there. Sean would too, Patrick would too. Just really blessed to have such a wonderful group of people trying to help us all get to where we want to go. I will have this call sent out to everybody. Hate to cut it short because I know people got questions and stuff, but want to be respectful of everyone's time. I hope everyone goes to Pints and Properties and nobody else dress up as a lumberjack. See you guys.
Thanks, Skylar. See you, everyone.
Thanks, guys.
Thank you.